please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The gross domestic product, or GDP, in the third quarter that ended on December 31 has grown by an impressive 7.2% versus an expectation of just 6.82%. However, gross value added growth, which is GDP minus taxes plus subsidies, has grown by 6.7%. That's just mildly better than the expectation of 6.6%. Well, economic growth has been abetted by a strong showing in agriculture, a growth of 4.1% in the third quarter. Manufacturing and construction have also grown strongly. So, is this the turnaround quarter? And can we expect growth numbers to start rebounding more sharply from here on? Those are among the key questions that we will be discussing on this show. Hello and welcome to the State of the Economy. Joining me to discuss the state of the economy are former Chief Statistician of the country, Professor T.C.A. Anant, Sajid Chinoy, the Chief Economist from JP Morgan, and Soumyakanti Ghosh, the Chief Economic Advisor at State Bank of India. Gentlemen, thank you very much for joining me in this show. Well, Professor Anant, first this overall question to you. Even when as Chief Statistician you gave us the forecast for the full year, you said that it is in danger of getting revised upward. And the CSO has actually done that. When you were there, you had forecast the first advance estimates at 6.1% GVA growth. Now the CSO tells us that for this year, we will grow by 6.4% GVA and GDP by 6.6%. Satisfactory state, you would say? Is this the platform for faster growth next year?
Yes, I think on the whole, the growth is faster. I think it's also important to understand that the revision is driven from a number of updated indicators which were not available at the time of the first advance.
Okay.
Also, in particular, it's important to highlight in agriculture, the Agriculture Ministry puts out two different sets of numbers. One is for the crop production, and then there is a whole bunch of numbers which they put out in terms of various advance estimates for the non-crop segment as well. What we are seeing in the agricultural growth, and in fact the improved number of the agricultural growth, is a fairly strong improvement in the non-crop side of agriculture.
Oh.
And some of this was intimated by agriculture in their revised estimate which they had put out, I think sometime in the month of December or January. I think January.
Okay.
Those improvements in agricultural growth are playing a role both in the improvement in GVA as well as in the strong showing of the agricultural growth.
Okay, fair point, sir. So you are saying basically agriculture is always, of course, agriculture plus forestry, fishing and livestock. You're saying that the non-crop, forestry, fishery and livestock probably did better.
That's right. So all of this animal husbandry, dairy,
okay.
Also to some extent horticulture, fruits and vegetables. Sure. Our attention tends to be grabbed by the crop production because traditionally that has been the most important part. But it has been a declining importance in agriculture. It is now probably just shade over 50% or just under 50%, I don't remember exactly.
Okay.
And its proportion has been declining over the years.
Okay. Well, that's important that non-farm rural areas have been doing well, and that's an important point for policymakers as well. In the current budget, we also saw some of the subventions being extended to animal husbandry, earlier only reserved for agriculture. But Sajid, let me come to you. What, according to you, are the positive surprises in these numbers, third quarter numbers?
Lata, a lot of focus will be on agriculture because the growth rate at 4% was higher than expected. But the fact is this is a broad-based recovery, and I think the best way to assess that is what we look at core GVA, which is GVA net of agriculture and net of public administration. I think that's the best proxy that you see of the private sector business cycle, and that has seen a solid pickup from 6.9% to 7.4%. We're now at the levels that existed just before demonetization in September of 2016. So for me, the positive here is more evidence here, tying up with the high-frequency monthly data, that the economy began to inflect 2 quarters ago, and last quarter this was broad-based. And for example, manufacturing grew despite there not being a favorable base effect, because manufacturing had grown at 8% the previous year in the same quarter. It grew again at 8% this quarter. A couple of caveats though, I think it's important to realize. The headline number of 7.2 was in part surprising, or was surprisingly positive, because the base from the previous year got revised down. So in the same quarter the previous year, GDP growth of 7 in the first round was moved down to 6.8. So there was a bit of a bump up that you got from that, and that explains some of the upward surprise compared to forecasts. One other thing I'll say is what's impressive about this is largely driven by domestic demand, because if you look at net exports, another disappointment. Compared to the previous quarter, gross exports have collapsed from 6% to 2%. Import growth has accelerated. So the global economy, as strong as it is, has not contributed to this set of numbers. Net exports has been a drag on growth this quarter. So the fact that GDP growth has accelerated so uniformly in this quarter, despite net exports being a drag, suggests a pretty broad-based increase in domestic demand, which is payback to the drag from demonetization and GST.
Okay. Well, Sajid has pointed to the core GVA number, Soumya, which you also spoke about earlier, net of agriculture and government services. It's a very strong number. If I were to ask you to look at the disappointments in the third quarter GVA number, what would that be, Soumya?
The disappointment in the GDP numbers in the third quarter, I think the first thing is that I think the story is playing out in terms of a quarter-wise recovery, quarter-wise number and a full-year number. If you actually look into the quarter-wise GDP numbers, they are very strong. But if you look into the yearly numbers, the bump up is not significantly on the higher side. But having said that, I think the first point to note is that if you look into the yearly numbers in terms of the investment one, yes, investment has accelerated the gross fixed capital formation in the third quarter. But if you look into the year-wise numbers, that has slowed down a little bit from the last year. So that is one point of disappointment. The second thing is that if you look into the service sector's number, the service sector number on a quarter-wise basis, I mean, even though on a full-year basis they have recovered from what it was last year, but on a quarter-wise basis you will see that the numbers are not trending significantly higher, specifically in the sectors like the trade, transport and communication sector, possibly because the demand is still picking up in the system. And the other thing which I would like to say is that in terms of the positives, if you ask me, I think agricultural sector and the construction sector stands out. The growth rate in the construction sector is 6.8%. I think is possibly the highest number which I could see from 2014-15 onwards on a quarterly basis. So that in itself is a strong omen for a possible better quarterly GDP numbers on a going forward basis.
Okay. Well, actually, let me toss that to Professor Anand. Professor Anand, construction usually draws from surplus labor in rural areas. In the past, in the rah-rah years of 2003 to 2008, we saw a lot of labor move from rural areas for construction. Construction again picking up, and as you pointed, non-farm rural occupations like fisheries, forestry, horticulture and animal husbandry doing well. Overall, do you think therefore that the rural distress is not as bad as perhaps we thought it is? Or at least on the way to recovery?
Certainly on the way to recovery. I don't know about how bad did you think and how bad is it, etc. with reference to that.
Well, there is a lot of farmer protest.
I do want to. Yeah, I think I do want to emphasize two things. One, which Soumya was pointing out just now, construction has shown signs of recovery, and if you recall, when last year I had released the GDP numbers and earlier as well in the first quarter numbers, I had pointed out that the construction sector has been a source of worry for some time now. And the major reason is the sector was affected by a lot of issues of poor governance. Those were sorted out last year around the same time frame as when demonetization happened.
Okay.
Now, the implementation of the Real Estate Regulatory Act is a major milestone in the sector.
Okay.
because what it does is it creates a platform for more healthy growth in the future. I think what we are seeing now is that the construction sector is slowly, I don't think it has fully made itself out of the wood. Resolution of the NPA problem will go a big way towards solving a lot of their problems. But as the construction sector picks up, you should expect to see two things. One, considerable reduction in the rural distress, and also significant improvements in the employment numbers as well.
Okay, gentlemen, we will have to take a break at this juncture, but we are coming back with questions on the expenditure side of the GDP. The capital formation numbers looking very good, but the private consumption looking a little soft. We are coming back to discuss all those numbers with our guests. Welcome back to our special coverage of the GDP numbers that were announced for the third quarter. It's coming in at a strong 7.2%, helped by a very good performance of agriculture, manufacturing, which is 8%, as well as electricity, which has come in at about 6%. The standout performance also came from construction. But we have to look at the GDP and the GVA numbers from the expenditure side, and there we are seeing a mild performance in consumption, which has grown by 5.5%, but a very good performance from capital formation, which is 12%. To discuss these numbers, we have been speaking with Professor T.C. Anand, former Chief Statistician, Sajid Chinoy of JP Morgan, and Soumyakanti Ghosh of SBI. Okay, to come to the expenditure side, Sajid, would you say this is a very good turnaround in terms of the gross fixed capital formation number picking up?
I'm going to be a little contrarian and reserve judgment on that part. I think we've seen in the past that quarterly estimates on the expenditure side tend to be very volatile. You've seen in the past fixed investment in a year's time has gone from an estimated 16% growth in June 2016 to less than 2% in 2017. Yes, there is some evidence here that capital goods production in the IIP data has picked up, but that number is notoriously volatile. So I think we should not hold on to one number and extrapolate too much, because if you look at things on the ground, the fact is in the last few months, corporate bond issuances have kind of dried up because the yield curve has steepened so much. You're seeing credit growth has picked up. It's largely retail. You're not seeing much credit to industry pick up. So, you know, in a way, it doesn't pass the smell test as yet to suggest that we're on the verge of a big capex cycle, especially given the deleveraging that's going to occur in the banking sector, and given, you know, very elevated yields among corporate bonds and government bond yields. I'll just make one quick point, Lata, because this affects GDP more generally, which is net indirect taxes has been a big driver between GVA and GDP. They're growing at 13% year on year. Now, we have to be a little cautious here, because part of this 13% growth is a very weak base. The previous year, same quarter, net indirect taxes halved from 12 to 5% in the quarter of demonetization. So you get this one bump up, but this is unlikely to sustain going forward. So GDP going forward is going to asymptote closer to GVA. And therefore, at some level, this buoyant GDP print slightly overstates the kind of true picture of the underlying economy, which is better captured by GVA. Okay.
Well, actually, Soumya also pointed that out earlier. But Professor Anand, your reaction to this discrepancy between GDP and GVA, as Sajid points out, there is a very weak base for indirect taxes last year, same time. As well, probably a lot of GST was collected, but the transitional credit was paid out in January. And is that why there is such a big discrepancy between GDP and GVA? Is that likely to reduce going forward?
See, I think Sajid's point is correct, that insofar as indirect taxes are concerned, there is a base effect which is operating in the third quarter. And I think we should also keep something else in mind. This year, overall net indirect taxes are going to be a little volatile because the GST weight is playing out. It's not clear how much of the money will actually, because government still works on a cash basis. Yes. So how much of it will be received through the month of March? Okay. And and in fact, the finance minister had also referenced this, that he's facing a certain degree of an arithmetic shortage in revenue as a one-off this year because of the transition to the GST and the manner in which it is happening. In the long run, I think the revenue process is going to be more robust and buoyant. So you may see next year a much greater divergence.
Okay.
But into the fourth quarter and the whole year as a whole, I think what we are giving in the second advance seems to be more reasonable.
Okay. Yeah, I think therefore we shouldn't get too euphoric with that 7.2% GDP as our experts put it. It's better to look at the GVA number, and for the full year that's growing by a modest 6.4%. It's not all hell breaking loose like the 5.7 that we got in the first quarter, but 6.4 is the CSO's forecast for the full year GVA, and even for the third quarter it is 6.7, not vastly bigger than the 6.6 which our economists had forecast in our poll. Okay, now to come to again to the expenditure side. Soumya, we've already been discussing this capital formation number, which is a very volatile number. The private final consumption expenditure has grown by only 5.5% in the third quarter, and for the full year as well, the CSO forecasts a 6.1% growth. Is that a spot of bother? Not very good consumption numbers?
No, I think that's a fair point, because if you look into the trend growth in the PFC, that has been around the range of 6.5 to 7% in the last couple of years. So from there, if it goes to around 6% or so, I think there is an element of demand laggard in the system. But having said that, I would like to add to Sajid's points regarding the investment. I think yes, I think it's notorious to look into the quarterly investment numbers, but investment, I want to put out one rider is that much of the slowdown in the investment in the last couple of years is also because of the fact that the households have actually shied away from this real estate sector. So that's why you will find that the household investment has declined rapidly in the last couple of years, and that is one of the reasons which is pulling back the gross fixed capital formation. So once the construction sector revives, I think that could actually act as a bump up to the overall investment demand in the economy.
Okay, fair point. And now to what clearly looks counterintuitive to all of us, Professor Anant. Population growth in the current year has been put at 1.3% compared to 1.2% last year. I mean, we thought our population is growing, but at a slower pace.
Look, I don't know about this. Let me say this. Principally, our population estimate is from the censuses, and in the intervening period, there is a method of population projection, which is done by on the basis of a recommendation of an expert group, which the RGI constitutes.
Okay.
My feeling is you may want to check with them. There may have been some change in the transit, because you know this population projection numbers are made for about a 15-year period, and they are then revised after a particular census, and a new set of projections are made. So something may have happened there, but broadly the long population dynamics which is revealed from the census data is consistently being borne out, that our population growth rates have been declining. This, as I said, without having further details, it's not really possible to say more than that.
Right. I'm sure, I think you're also fighting a back throat. Professor Anand, thank you very much for that explanation. At least it removes doubts about the long-range movement of our population growth pattern. Well, final questions to you, gentlemen. Sajid, is there enough spunk in this to say that there can be a sharp rebound in the coming quarters, or is this just mild growth?
I think we need to separate the next few quarters, Lata. I think the next quarter you could accelerate even further. And this is principally because there is a very favorable base effect in the Jan to March quarter. But to be fair, also, you know, the sequential momentum of several high-frequency indicators is increasing. So I think next quarter will be stronger, and we'll think that we're in the midst of a broad-based recovery. But just a cautionary tale here. I think next year there are two reasonable headwinds. One is if oil prices remain close to 70, that would be close to a 20% increase compared to the previous fiscal, and that will impinge on growth. That will be an adverse terms of trade shock. The second wild card, really the elephant in the room, is the banking sector, that if on the back of recent events we see more deleveraging, more risk aversion, lower credit growth, then that is also going to be a headwind towards growth next year. And the surprise really is why India is not participating more fully in this very buoyant global recovery. 2017 saw the strongest growth in the last 7 years. Exports in India have been very soft compared to historical averages. Imports are strong, so net exports, rather than being a tailwind, have become a headwind, which is very surprising. So I think let's enjoy the moment while we can. We still expect growth to pick up next year, but I think the acceleration could be muted. We expect growth to be 6-7 this year and maybe 7% next year because of oil prices and possible headwinds from a banking system that gets more progressively more risk averse.
Sure. Okay. Thank you very much, gentlemen. Actually out of time, but let me quickly try and summarize. The GDP and GVA growth have picked up, but it's not as superb as the 7.2% indicates. That 7.2% GDP growth in the third quarter is more because of a low base and probably because of volatile tax collections. More generally, the GVA has grown by 6.7% for the third quarter, and for the full year it's expected to grow by 6.4%. Still better than the earlier estimate of 6.1%, but still it is an economy that has slowed from the previous year. That's the positive. Positive also in very good construction growth and very good performance of agriculture, forestry, animal husbandry and allied services. Our experts point out that it's the allied non-farm part of rural India which has shown substantial growth, as Professor Anand pointed out. That's again a second positive. Construction doing very well is a very big positive. The worrisome part, consumption is not growing very fast. It's just about 5.5% for the third quarter, expected to be 6% for the full year. Not very good. Capital formation looks very good, but that could be a volatile number. We have to see whether we can keep up. The fearful part is exports are indicating that India is not participating in the great global growth story. Is this a turnaround quarter? It's just good. We don't know if this will go on into great guns. Much will depend on how the banking sector performs and how the construction sector is able to respond. Thank you very much for joining me in this special Indianomics, which analyzes the GDP numbers for the third quarter and for the full year.